Here from Wealth Migrate today. Just before we go on today, we're just going to wait for another few people to actually log on, and you can just have a quick read through to our disclaimer there at the moment. So we'll take about 90 seconds for everybody just to familiarize themselves, and we'll take it from there. Thank you very much. I think that's right now, so I think we can go on. Thank you very much, everybody. I think today, just before we start, I would like to introduce my esteemed colleague for the day, called Veli Ilos. He's actually the head of our due diligence and our analyst, and actually vets all the deals and puts it through to the platform. And just a bit of a background about Veli. He's been in the investment banking industry for roughly about 18 years, is that right? And he spent some time in London with one of the bigger investment banks as well, roughly just around 2007 to 2009. And after that, he ventured back to South Africa, been involved in the financial analysis industry. He's a guru at setting up financial modules and Excel models. And really just a big thanks for making time to chat with us today.
Yeah, great to be here. Welcome, guys.
And just maybe a bit of background about myself. I've been with the company for a little over a year now. It's been absolutely a privilege to be involved with such a forward-thinking company. Myself, I've been involved in the commercial real estate sector for just over 4 years, and it's just been a massive privilege to be involved in this change that we are bringing towards the sector. So I think what we're just going to do and go through the agenda, what we're going to touch on today, we're going to have a little bit of a chat on who Wealth Migrate is, where are we coming from, and then we'll be mainly delving into what's happening in the healthcare real estate sector. We'll give you a proper market overview, and then we'll go into some details on some of our current investment opportunities, more specifically today our Medical 7, and we'll touch on some can I say, principles and who our partners on the ground are, who we'll be getting involved with. So I think without further ado, thank you very much and for attending, and we'll look forward to have a good conversation. So let's go back. As I said, thank you very much for joining, and we will be discussing what's happening on the medical real estate field there today. Just for the people who are logging on the first time, just to give you some background on Wealth Migrate. If we can just go onto the slide there. Yes, so Wealth Migrate in all, we actually bring transparency, independent insights and accessibility to the global real estate investment marketplace. And I think what's a big differentiator for us is we actually do this and manage to accomplish this through a listed environment, and that's a big differentiator from Wealth Migrate and any of the other crowdsourcing investment funds in America. We use our global investment due diligence system, also known as the GIDS, and this we use to ensure global consistency and safety, wealth preservation and sustainability in the real estate markets. Over the last 3 years, we've concluded just over 6 commercial real estate investment projects, and in total, the values and the assets under management has just recently exceeded over $100 million. And I think that's one very big feat, specifically for a company out of South Africa, a small startup entrepreneurial company. We've come across over the last 3 years, and the growth we've shown is really significant. And maybe just to give you a bit of an overview of the typical projects we get involved in, we have growth investment opportunities, which typically range from 18 to 36 months. This is where you'll normally partake in a development, whether it be an office block or a high-rise apartment building, and you actually get the opportunity to be a co-developer, and this is actually groundbreaking, and this model of us is very exciting. And on the other side, we've been more involved in some income investments where we actually acquire existing properties that's got a current contractual income running. We buy this to actually gain a secure investment cash flow from our hard currency first world income. And these are mainly our core focuses up to date. if you have a look at the different returns that our opportunities actually offer, the internal rates of return range from about 12 to 19.5% per annum. What that actually means is over an investment period, you'll receive an annualized return of about 12 to 18%. And the dividends on our income projects are typically paid quarterly, and they yield about roughly 7 to 9%. I think just before we go on, I think just to give it a little bit of background, we want this to be a very interactive session. We want you to be involved. You are welcome to participate. You'll see there in your chat box, you're welcome to, if anything pops up during the webinar, you're welcome to ask us any questions, and we will start actually working with you and answering some of those questions while we're going through. I know that we did say actually we're going to have a little competition today for everybody who is online, and just about that, we will be giving out a hard copy of Scott's Property Going Global book, and I think maybe if you want to stand a chance to win that, I would ask you to actually log onto the website at wealthmigrate.com, go and look in at Medical 7, the SG Properties investment that is available. Go and see what the return calculator can actually calculate, and I would actually give the prize to the first investor who can tell me what will the actual return be if you punch in $127,000 invested in this project. So that will be our competition running for the day, and the first one that we see through that will actually win a hard copy of Scott's Property Going Global. This is just a quick look at the opportunity that we are having available. Well, it's launched 2 weeks ago, and it's called the Medical 7 from SG Property, and it's located in MACARTHUR, the Medical PLAZA. I'm just going to hand over to Billy quickly to give us a little bit of an overview on what the GIT system is and how we look at these type of deals.
All right, yeah, thanks, JP. What we usually consider and it is important and is forming part of the GIT system is, firstly, we look at the sector preference, location, population growth, financials of a deal, the risks surrounding the deal, meaning not just the property itself, but as well as the macro and micro risks that we have to consider. Does the investment offer a value play, and what is the sponsor track record? All these combined, forms part of our GIT system, and according to this, we weigh all these different aspects into giving you a number. And and this is basically also the points that we will, during the course of this session, cover.
Thank you very much, I think it's an imperative thing for us to have and to ensure, as we said, global security and global sustainability in our returns. Just to maybe touch a little bit on the medical real estate and why is Wealth Migrate so attracted to this, and why is it for us an appealing sector to be involved in. I think, firstly, according to the DLA Piper, which is it's a major research firm in America, and they have been quoting the healthcare sector as the most attractive specialized investment sector over the last 3 to 4 years. This has also been, can I say, confirmed again in their latest report late last year. So the sentiment in this sector is very healthy, and underpinning that good value is a consistent demand due to the strong medical office space that's been actually experienced on the markets at that side. From a Wealth Migrate perspective, Henny Besaidenout is our chairman at Wealth Migrate, and he's been involved in the medical developments in South Africa, and he's been investing in healthcare real estate for the last 20 or 30 odd years. And he says doctors are typically the best tenants that you can have, and one of the main reasons is that they typically sign very long-term leases. Now, reason for that being is that, firstly, when doctors move into a place, it's very expensive to move in those expensive equipment. So that means the tenant installation cost is very high. They've got very advanced and sensitive or difficult technology that they need to move. So they kind of secured into that place for a very long time. And from an investment perspective, what that means is we've got a secure cash flow, and that's one of the ultimate things we are looking at. You'll also see that, I think in your own life, have you ever noticed a doctor in your personal life who actually moves an office? And logically, they don't typically do that because they're patient-centric, or their patient area in the geographic is their core business. So why would they up and go and try and make a new name for themselves in different markets unless they really have to. So the long-term lease and the demand for space in that area is a very big positive, and that's one of our core focuses and main attractions to the healthcare sector. You'll see there that the vacancy are currently at a 9-year low at the end of last year, and this is also once again underpinned due to the continued demand due to some of the above mentioned factors we just spoke about. The sector is currently shifting to a more patient-centric care delivery model, or what that also means is an off-campus demand model, meaning that doctors typically start taking their practices maybe a little bit away from the actual hospital, where people can come into a day clinic, get all of their sicknesses checked out, get them all sorted out without actually checking into a hospital. These on-campus medical officer space continues to rise in demand due to these expansion programs currently happening in the markets, and due to this happening, the current demand is consistently compressing the cap rate. So what that effectively means is actually there's a big value add just to the trends and the growth in the areas that the cap rates are compressing, meaning that your property will actually appreciate in value over a little bit of time. Maybe to focus a little bit more on why we believe Texas is a good opportunity and a good market to involve this. Texas is an at-will state. What this means is, can I say, employers, they can fire and hire at will. So if somebody is in my organization, he's not producing the goods, I don't have any issues actually firing him, getting him out of my organization. And what this effectively means is that the production is going to be a lot more efficient, which is ultimately good for business. A very big consideration for us is that the medical malpractices are capped in the state of Texas. What this means, believe you can confirm it, I think it's capped at $1 billion specifically for those doctors. But what this means is effectively doctors do make mistakes, but they cannot be taken to the cleaners and lose the entire business. So there's a business security in the state of Texas, which is also a main attraction to and incentive to attract doctors to the area. There's also no state income tax for goods in transit tax payable. So this is a major attraction for businesses to actually move into Texas. You'll see that the annual economic output currently exceeds $1 trillion. Also, Texas is the largest exporter of goods in the USA. They gross currently about more than $260 billion a year in trade. If you have a look at also their gross state product is actually bigger than Australia and South Korea. And for a state in itself to achieve economic output of that is really significant. It's also, as you'll see there, the second largest population in the United States, just behind California. They are forecasting growth to about, I think, more than 40 million residents in the next 9 or 10 years. So that's also underpinning of one of our values. We always invest in markets that has strong population growth, and that's just actually confirming one of our core market strategies and values we invested. If we take a look at 80% of the state's population actually do reside within the Texaplex. Now, for those of you who don't know about what that is yet, the Texaplex is you can call it a triangle of 4 states, and it's formed by Dallas, Fort Worth, San Antonio, Houston, and Austin. And what's significant about this is these are actually recognized as hotspots of innovation, opportunity, and growth. And we tend to try and take advantage of opportunities within these areas. Maybe moving over, Billy, do you maybe want to shed some light on why Dallas Fort Worth in Texas is so attractive at the moment?
Yeah, no, thanks, JP. Dallas Fort Worth is basically made up, or Fort Worth is next to Dallas, just to the west of it. Both these cities have grown to such an extent that it's actually grouped together, and it's called DFW. And what is quite just an interesting fact there is that the first convenience store, the 7-Eleven, started in Dallas and is still headquartered there today. The integrated circuit computer chip, the microchip, was invented in 1958. That's just some interesting facts to note. But the more important thing for us is it's one of the biggest cities. One of the things that is part of our investment criteria is that we're looking at gateway cities. And because of this, it's not only just a big city, but it also has been one of the fastest growing metro for the past decade. Like JP already mentioned. That's also one of the important things for us. There need to be population growth, either by people migrating to that particular state or town, or basically growing population-wise through births. What we've also seen is that they are forecasting 10.6 million people to live in the DFW area, which is a 47% growth, as there's currently already 6.9 million people living in DFW. As I already made mention to, Gateway City is also very important, and that's why DFW airport is the 4th busiest in the world. There's 174,000 people on a daily basis traveling through this airport, which is a great thing. And that's also one of the major things for us to consider is we don't want to be stuck with one sector in a particular town or state, and that's what's so appealing about Texas. Even though we know that Texas and specifically Houston are one of those towns that is renowned for the oil, and the oil belt is actually running from Texas up to North Dakota. This is why it's such a big hub, and the economy of Dallas is actually 20% of the GDP of the town is basically made out of transport and trade and utilities. That's about $77 billion per year just from the transport, and most of them are driven basically through the airport and the lines, the highways through the country. The GDP of Dallas is also projected to grow by 4.25%. Some of the awesome highlights and accolades that Dallas-Fort Worth has received is it's the most business-friendly city. It's number 3 in the hottest housing market. We've seen an abundance of growth to the northern side of Dallas, and that's one of the reasons why. It's also because of what JP mentioned, is that cost of doing business is 7% less than the national average, and for that reason, it makes it quite attractive for business to start up in Dallas. So when we look at the neighborhood, you can see it's quite well located, and there's a lot of hospitals in the area itself. The neighborhood is called Irving, and even though it's an established older area, it is still growing. We have seen in the past year it grew by 7.9%, and it's still forecasted to grow another 6.4%. 60.6% of these residents are within the 18 to 60 age group, which means this is more work-related families, startup families. If you look at the number between 21 and 34, 42% of this 62% are actually made up by millennials, and which means it's why it's such an attractive place to be in. There's growth, there's youth. I already mentioned it's all the facilities where the hospitals are there. You've got the University of Dallas that's also close by, and that's also why you should be seeing a sort of a lower number in the age groups being part of the neighborhood.
Billy, just to interrupt you, thank you. I see that there's some questions actually coming through. I see that it's actually quite relevant to what we're talking about. Nick de Gokulas actually asks, is there current competition for medical facilities in this area?
Well, I think the important thing to note here is that the particular building that we are acquiring are actually more specializing in particularly the obstetrics, gynecology, and pediatrics. So from that perspective, there is a number of other medical facilities in a close vicinity, but all of them are like we've already mentioned, in the medical health industry. Most of the doctors are moving off campus, and these are the typical medical facilities that you'll see in the neighborhood. They're not directly actually competing against each other, just because of the fact that it's a medical space. What we also see is that the hospitals in the area, like I mentioned, there's 5 in the vicinity. There's more than 8 facilities, But the particular MacArthur group that holds 67% lease in the property, they are actually contracted and is sort of what we call a primary healthcare facility that actually feeds these hospitals with children and different additional specialist services. So yeah, I hope that answers your question.
Yeah, thank you very much, Billy. And please, everybody, do keep these questions coming. We will try and answer them either throughout if they are relevant to what we're talking about now, or as soon as we reach the question and answers section. So thank you very much for that question, and we will definitely be going ahead and answering them as we go.
All right, cool. Yeah. So what is the deal? What is the numbers? What can you look forward when you participate in looking into this investment? Like I said, it's in Dallas, Texas. The building is, or the portion that we're looking to buy is actually 42%. Sorry, 42,000 square meters. This is actually a condominium made up of 67% that we are buying in. The term and the duration that we're looking for is 5 years. The internal rate of return is 13.48% that we should be looking to achieve over the period of 5 years. Just a note for internal rate of return. It's basically just to ensure that we quantify the time value of money, and that's why we like to compare the internal rate of return against the other investments that we look to invest in or bring to the platform. The average cash on cash return is going to be around 8%. It's going to be paid in quarterly dividends. We're looking at a minimum investment of $10,000, and the closing date is going to be the 20th of March. And that's one of the reasons why, if you already maybe you considered this investment a week ago, you would have noted that we've raised the minimum investment to $1,000. It's just from a timing perspective, and yeah, I think if you already started your process, you're still more than welcome to contribute that. So what is the building? How does it look? It actually consists of 5 buildings. We are buying 67%, as I made mention of, which as a condominium, it means that we basically have majority share in making the decisions of the property owners association. It'll mean that we shouldn't have any problems if there's any specific needs of the building to be attended to ensure that happens. What makes this building quite great is the fact that the portion that we are buying into is 100% tenanted, and 65% of this tenant lease actually expires in 12 years, which means that we have a bit of a cushion there, and we don't have to do a lot of admin. I think if we've got the next slide showing, I'll get into more detail into the what do you call it, the lease mix. What do you want to know more? The building is built in 1968, which is a bit older than what we usually will look at. Our criteria, we actually don't want to invest in buildings that's older than 10 years, unless there's been work done. And what we've done and had a look at is that the work that has been done was recently they resealed and look at just re-establish the roof, looked at the parking bays and the overall exterior of the buildings. So how can we be sure that this has actually been maintained and kept? One of the things in the closing costs of the building is paying for third-party reports. These reports actually consist of a property condition assessment report, and from a maintenance perspective, we are actually are required to put aside $0.15 15 per square foot aside during the course of the investment to ensure that we keep this building kept from the lender's perspective. So you don't have to be concerned that there's going to be money, money required to maintain this building. It's already been budgeted for in the building or the cash flow. So this is the lease expirations, as I mentioned. As you can see, is the first lease that possibly will expire is going to be in 2020. For this reason, if you look at the returns, if you had a look at the brochure earlier or the property offering, you might have noted that the cash on cash over this 5-year term slowly decreases. The one reason to consider here is that we are fortunate that the lender granted us an 18-month interest-only period when we take over this building, and for that reason, the year 1 there's no principal payment due. Year 2, there's half of the year there's going to be a principal payment kicking in. So from year 3, we will be seeing that there's more the full principal payment going through, and that is shown in the cash on cash that is going to be paid out. Year 4 is when we will see this first lease expiring. Now we're quite confident that we shouldn't see any vacancies coming up, but as you all know, is that we don't have control over that. But we are confident that we should be keeping the building fully leased up. But in being the conservative banker that I am, I made provision for this, and for that reason you'll see that year 4 and year 5 the returns are a bit lower, just from that perspective to make sure that we're conservative and we're not over promising and under delivering. Right, let me just carry on. So this is a couple of pictures. What we are buying on at this stage is buying at the cap rate of 8.22%. The current cap rates are around 6 to 8% for these type of buildings. We are, like I said, want to be conservative, and we're forecasting around a 6.5% cap rate over the 5-year when we want to exit this building. The property, the purchase price per square foot is around $218. That compares well to the market range of around $190 to $315 per square foot. But you have to take in consideration the lower end of it is usually because of vacancies in these buildings. So for that reason, we are quite confident that we are buying this building at a proper market-related rate. What I also have to mention is the fact that the value play that we're having here is the possibility to purchase the condominium, the rest of the condominium, and we are quite confident that we could be seeing adding that to the fold. But in essence, this is a stable investment. I think the risk is a bit lower because the fact of the matter is that the tenants are well kept. They are reputable medical tenants. We've vetted them, done the credit checks. It's long-term leases, and for that reason, we see this more of a stable investment in itself. So, what is the risks that what we considered here? You probably already read through it already. But what is important is there's 3 aspects that we always want to consider in purchasing a building. The most important thing will be your tenant risks. Failure from the tenant to honor his lease obligations. That means by either going out of business or maybe just not paying. They're not good tenants, they don't have a good reputation. Interest rate risks, inflation, Fed raising rates. I mean, we've been hearing the talks of the Fed now that there's a possibility that now in March they're going to raise the rates again after they've done so in December for the first time in a couple of years. Then the other problem would be and risk that we technically don't have real control over is the valuation risk. We're projecting for a cap rate at 6.5%, but the economic conditions might not be as favorable as it is now, and we unfortunately have no control over that. But what have we done to try and mitigate these risks? So firstly, as I already made mention to, is we want to have a solid tenant in there that's got a proper financial position and has been in the market for a number of years. We want to have long-term leases in place, at least 5 years. Best what we want to see is between 10 to plus years. But what you see in the market usually is between a 3 to 5 years with the option to extend. As we've made mention to earlier, is the fact that it's a medical building. We want to see these investments. Sorry, just lost my track there. Because of the medical aspect, and the doctors don't want to move, they will use the option to carry on. What we've made also sure is that the debt cover ratio affords us that if, for instance, we do have a vacancy for whatever reason, we can actually a 25% decrease in revenue will still be in a good place. We'll still be kept in a good place. So what we've done on the interest rate side of things, we fixed this rate for 5 years. It's going to be around, we're forecasting it at 5.25% that the rate's going to be over this period. As the deal is not closed yet, this rate is still, it's linked to a 3.15% over the 5-year swap, treasury swap. Last that I looked, it meant that the rate would have been, at this point in time, if we fix it today, it's going to be just over 5%. So we again are a bit conservative. If we can close the deal in time and there's no real heightening interest rates, it'll mean we'll actually have a benefit of an extra couple of basis points possibly on the interest rate side. On the valuation risk side, we've lowered our gearing on our investments. We've typically usually looked at a 70% loan to value. We've dropped it down now to a lower value of 64%. As I already made mention to, the debt cover ratio is averaging 2 times the net operating income. And as I made mention to, is that if the revenue starts decreasing, the current criteria of the bank is 1.25%, which means we've got a nice buffer to play with. The other thing that also is important, what happened in 2008, is the banks needed to be capitalized, and that's the great thing is that we've partnered up and using a lender like Capital One, which has got a strong balance sheet, and we shouldn't see any problems with them wanting to change their terms or anything like that. And that's the main aim for us, is to ensure that we don't have a capital call risk at the end of the day for not meeting these criteria. So now, I think the biggest question on everyone's lips, possibly JP, is the fact of Mr. Donald Trump, the new president of America. He's been promising and writing executive orders, has been widely publicized. One of his main things that he started with was the Affordable Act to repeal it, and I think the great news about it is the fact that what we need to consider when he says that, what is it gonna affect us? Is it gonna have an effect on the medical sector? Let's just review that point for 1 second, and then just from a perspective to put it in context. So the first thing that you have to consider is that it's going to take time to roll this back. It's not going to be easy. You've probably heard it in his speech now. He needed to change his tone on it. But what is important to note is that currently there's only around 18 million. These numbers that they're talking of, maybe over 20 million people that's actually made use of the Obamacare. The reality of this is, if you look at the population of the US, that's actually only 6% of people in the US that actually made use of the Affordable Act. 84% in America of the population has some sort of health insurance. Can you believe it? I mean, that's just unheard of. In South Africa, only I think it's around 6 million people or something like that. It's not even enough, just to put it in context. That's 272 million people in the US that actually has got health cover. 55% of these are actually provided by employers, and 10% pays of it is being paid through services, and the other 31% is actually public, Medicaid, and such. So what we're also seeing is the fact that he wants to have an infrastructure spending. He's talking around $1 trillion that's going to be spent on the infrastructure. One of the main things is going to be the Dakota pipeline. That's already also was one of his agenda points. And all these things have actually are going to raise the jobs, the growth, the money being spent, which effectively is going to have an impact on us, on us in the sense of the interest rate rather than the concern of the Affordable Act. You know, so we don't see that the Affordable Act is going to be a big problem. I think JP, you've got a couple of notes there of his speech that he made mention of because of the from this Obamacare.
Yeah, I think it's important just to note what he said. I mean, with the repealment of the Affordable Care Act, he said that they will firstly ensure that currently Americans with pre-existing conditions have access to coverage. So it's people who already had an existing condition and who was on the Affordable Care Act will not suddenly just lose their coverage. You will ensure that these people still have access to medical facilities, that they will have coverage and to still actually get the proper medical care. That being said, that will actually mean it will be a stable transition for these Americans into the new healthcare exchanges. He also mentioned, secondly, that he wants to help the Americans to purchase their own coverage, but by actually using that through a lot of tax credits that he's going to implement. He's going to expand on the healthcare saving accounts, but this is just a plan that they want, and it's not going to be enforced then by the government. So I think that just immediate takeaway is that people are not going to be left in the dark. People who are currently dependent on these healthcare, he will take care of them first to ensure an easy transition into the new healthcare exchange. He said also thirdly that he would like to give state governors the resources and the flexibility they need with the medical aid to ensure that no one is left out, as we mentioned. Fourthly, he said that he's going to implement some legal reforms that will protect patients and doctors from unnecessary costs that drive up the price of insurance. Once again, it's just going to make the insurance a lot more affordable and efficient at the end of the day. I think maybe just moving on with regards to some of the impacts on the infrastructure spending that he's planning, but he did mention that he's planning to produce just more than $1 trillion of investment into the infrastructure. And I think just the fundamental thing that's important there, it ultimately just does well for the business environment. It's going to provide for more efficient business operation. It's going to ease business, just not from the tax, but business operation. He also said that some of these sectors that are currently maturing and in these rising interest rates will actually expect to compress the cap rates, and that's effectively what Wealth Migrate is always looking to invest in markets with compressing cap rates, meaning that for our $100 of net operating income, if we move that from an 8% to a 6%, our capital value will grow over time. Another thing is, with these infrastructure spending, there's going to be a lot of job creation, and also with the creation of jobs, people will have to move into Africa, into America. Another thing is also the migration is that there's going to be more job opportunities for Americans. It's not where the call it foreigners had jobs in South Africa and in America and spent it outside of the country. So that will actually ultimately stimulate GDP growth, is giving the jobs to the Americans where they can spend the money within their own country. Maybe just a little bit of an impact on the tax cuts. Billy, do you perhaps have something to add on that at the moment?
Yeah, I think the one thing to consider is the fact that he wants to ensure that the people of America has got more money in their pockets to spend, stimulate the economy, which effectively as well, as JP just mentioned from his speech from I think Monday or Tuesday, is the fact that he wants these people to be enabled by these tax cuts to afford the healthcare, which again is boding well for the healthcare industry, and which effectively means that the medical facilities that we have invested in the past 2 years, 3 years, will perform as we expect them to do.
I think, yeah, that's perfect. And just one thing to note that he actually did tap into big real estate moguls like Richard Lefranc and the Steve Roth to actually oversee this infrastructure spending. So that's just boding well that I think having people that are really well versed in the real estate sector will always have the main can I say implications at heart for what's good for the real estate economy as well.
All right. So when will we exit this transaction? How will it work? So our exit strategy will be that we are planning to hold this property for 5 years. During this holding period, as investment committee, we've got an independent investment committee, which I basically also are part of, and we've got the chairman being involved in it, and guys from particular fields outside the organization that is not part of Wealth Migrate. It's been part of the real estate market for a number of years. They're experts in their fields. They are reviewing with us the market conditions and to ensure that we get the best exit opportunity for our investors, the investors. By year 5, the property will be placed in the market. Unless the market conditions prior to year 5 is so favorable that we can exit it earlier, we might. If Wealth Migrate receive a favorable unsolicited offer during the next couple of years and it makes sense, we will exit it. Or if the market conditions at year 5 is to such an extent not favorable and it's not in the best interest for the investor to sell, we will postpone the exit. So how does it going to look? Our platform has got the ability that you're able to look at your wallet, and this is basically what you'll probably see if you invest an amount of $10,000. We'll have a quarterly dividend. This is based on year 1 of around $214 per quarter that's being paid out. Which means you're going to look at $858 on year 1. It, as you can see, as I noted earlier, progressively goes down a bit. I mean, there's a lot of things that can influence this. If we don't see the tenants moving out, like I mentioned, you can see probably different numbers at the end of the day. So what does it mean? In your pocket, during the course of the investment, you'll have $15,822 for your investment. So when we partner up, one of the points that JP made, well, I think I made mention to that we consider is we need a solid property partner. We've built Scott Picken and Eni Besaidnout. They've built relationships across the globe with specific partners in mind that fit the Wealth Migrate partner criteria. One of the most important things, they have to have at least 10 years of experience in this particular field, maybe medical, maybe multifamily, maybe self-storage, and they have to be a niche market player. They must be able to sponsor the debt. That's why you would have seen that on the splits at the end of the day, there's a 50% above hurdle that goes to the investor, 25% goes to the sponsor, and the remainder goes to Wealth Migrate. For this particular reason, is because they are taking the risk on the investor's behalf. If you compare it to a normal transaction, if you are wanting to invest in a property and you don't have all the money, you put in some equity, but you still stand surety for the rest of the equity. So for that, I almost want to use the word privilege. They also share in the pot, but it's a privilege for us that they're partnering up with us. Also should have an available pipeline of deals. I've already evaluated another deal during the course of the week. So they're consistently bringing us transactions that we can look into, and if it fits our criteria and the investment committee signs off on it, we present it to the investment community to partake in this venture. All right, so they're specializing in medical real estate. They are successfully managing the properties. Some of you might have already invested with Wealth Migrate previously with medical 1, 2, 3, and 5. SG Properties are our team on the floor, and you would have noticed that we've actually overperformed on what we've promised already, or not promised, rather, let me rephrase, we don't promise. We just estimate and project on our projections. We've already been able to, on these transactions with SG Properties, successfully managing these properties, actually been able to be in budget and give the investors a bit more than they previously bargained for. All right.
So yeah, thank you very much, Billy, for that insights. Really appreciate it. I think maybe just to summarize what we've touched on today, we've had a look at why medical real estate is one of our sector preferences, and not just us. There's a lot of private equity firms and institutionals that are looking investing in these sectors, and it's underpinned to these reasons that we spoke about now, having doctors as long-term tenants, the security and the underpinning the business of these operations. Also having a look at the aging population. I mean, America, the people are, well, not just America, but everybody tends to live longer these days with all the healthcare technology, and that just underpins the true demand for healthcare as a business from a doctor's perspective. We touched on why Texas and Dallas is so preferential as opposed to other states. We also once again said that population growth is very important for us, and a positive population growth of the states and the metro is always something that we look into in everything that we analyze. We're looking at the financials. We said that the specific deal will produce you about an internal rate of return of 13.46 on average, and a cash-on-cash deliverable of 8% per annum. And we did touch on some of the risks that people are having out there and wondering about, and we discussed on what will unfold with whole Trump in the new seat, what's happening on the interest rates, and actually what measures Wealth Migrate has taken to mitigate these risks. I think it's important, and I think for us to realize that we've managed to fix some of these rates and we've lowered the loan to values. It's just in measures ensuring that we have a sustainable returns over our projects. We did talk about possible value plays in this project, solid asset classes with the potential maybe to acquire additional suites within the condominium, to have full control over that. So there's a possibility of that happening. More updates on that in the future. And we just touched now briefly on the track record of SG Properties and why it's so important at the moment. I think that's us for the day. Thank you very much, everybody. And we're going to open it up the floor now to some questions that came through at the on the door. I'm just going to have a quick read through to have a look at what's come there. Michael actually asked, can I invest from my LLC or any foreign entities or structures? Billy, if you perhaps maybe want to shed some light on that one.
Yeah, I mean, this opportunity is for the guys that previously have LLCs in the US. You are still able to invest in through that structure. We've set up our platform to enable you to do it more conveniently through the Seychelles structure, which means that there's not going to be any additional cost for you. You can open it up on the website, just do your KYCs, and then transfer the money with no added cost except for your banking transactions, which we unfortunately cannot bargain for you on your behalf of. But yeah, so yeah. But if it's still affordable for you to use your LLC structure, please invest through that.
Thank you, Billy. Just another question coming up here. James said, if we don't actually get an actual share certificate, how do I have proof of my investment should something happen to me? So that's a very valid question. And if you look, once you've done your investment, you can look actually on your dashboard. You will get a blockchain code indicating that that's the proof of the transaction within this investment. And I know it's a virtual thing and it's online available, and so we're not necessarily going to know what's happening when something happens to you. And I always say, just always take a screenshot, maybe print it out, give it to somebody in your family, share them, somebody that you trust, their login details, that should somebody know that you invested with Wealth Migrate, that will serve as your proof of investment at the moment. Geez, the questions are coming thick and fast at the moment. How does Wealth Migrate make its money? Mark Green actually asked us that question. Really, do you care to elaborate maybe perhaps on that?
Yeah, sure, Mark. What Wealth Migrate basically takes above hurdle rate, like I mentioned earlier. So if the investment does perform over 7% annually, Wealth Migrate shares in that instance, yeah, what we call a super profit, which means we get 25%, the sponsor get 25% for the risk that he's taking on our behalf, and the investor have 50%. At the end of the investment, Wealth Migrate will, on the capital gain side, will also receive 25%. We as Wealth Migrate, just from a due diligence perspective, has got a fee that we take upfront on the transaction just to pay the bills.
Thank you, Billy. Mark Green actually had another question here. If transferring money out of South Africa, presumably this counts as a foreign investment for SARS purposes, and we need both SARP, the South African Reserve Bank, and SARS clearance in order to do so. Are you able to offer advice in this regard? Mark, we don't actually offer any advice, but we have partnered with Sable Forex, who actually assist us, and majority of our clients in moving the monies abroad. We are happy to put you into contact with a Sable consultant to assist you regarding that. Do you need to form a company in the USA? Coming from Nick. Billy, maybe if you want to elaborate on that.
No, Nico, that's what I made mention to with the LLC. You have to do nothing except go on to wealthmigrate.com and go through the process there, which is simple and easy. You just do the ticks, the normal filling of the forms where you put in your names and load up your KYCs. And that's the amount of opening that is required from your side, as we've done the rest for you.
I see Nick just has another question here. What happens about taxing in South Africa? Just once again to clarify, we're not tax advisors or consultants. We always would refer you to your personal tax consultant to, in a manner, how to handle these. Maybe to clarify, these investments, your returns will be based as dividends, so they will be taxed in dividends wherever you are in the legislative domicile. But it's always better to seek advice from your personal tax consultant and advisor.
So just to add the with regards to the investment in itself, we've transacted and set up the structure to such an extent, and that's why we on the brochure you can see what the returns are going to be and what you're going to have in your wallet. That's after tax. That means that all the taxes are already being paid in the US. So the only thing that you're going to be liable for is the dividend tax. What I just can mention, the guys that goes in through the normal LLC structure, as you probably would have known by now, you will be then liable for your own taxes on that side as per what your company's performance are.
Question coming through here from Neville Jenkinson. Thank you very much. When will the wallets be in place for paying in Bitcoin? So that's definitely something that we are busy working on, and it's definitely in enrollment in the near future. I think we'll just have to check with Jaco Maritz. He's heading that operation. So it's definitely going to happen in 2017. We're just setting up the right structure, so we don't have a definitive answer yet, but please feel free to contact me. My contact details will be available at the end of the slide there. You can see, you can email me at jp@wealthmigrate, and I'm happy to follow up that with you with Jaco Maritz. And also just want to announce our winner for the competition today. Congratulations to Ken Harventer. He actually did manage to find the return calculator on the website, and the answer was, if you invested 127,000 dollars into this project, you will return after the 5 year roughly an estimated $200,000. So congratulations, Ken. If you can please just provide us with your physical address, we will send you a copy of Scott's hard copy of Property Going Global. You're welcome to email me that at jp@wealthmigrate.com.
JP, maybe before you continue, do you want to just run through the next steps for the guys?
Yeah, perfect. So guys, if you feel really you're comfortable with everything we've shared with you today, please go and sign up on wealthmigrate.com and review the deal. Everything we discussed there is available on the brochures and the project offerings. You will get access to the property supplement, which will go into a lot more detail on the deal specifically and what you will be purchasing in. You can select your investment and transact online, and after that it's going to be very smooth. So initially you have to submit some documents to get your FICA, and after that it will be really easy to start investing and managing a portfolio. So please go and log on wealthmigrate.com, and we look forward to seeing you online.
Maybe just
Thanks, guys. Great webinar. Cheers. Thanks, Neville. Thank you for attending. Mark Green, can you provide a typical high-level cost breakdown of a $10,000 investment plus fees, etc.? What would that be? Yeah, Mark, just think one thing to be important. If you have a look at the financial analysis on the brochures after logging onto the website, all the returns that we quoted are actually net of all those expenses. So you'll see that there's a breakdown of all the costs involved, whether it be the Wealth Migrate due diligence fee, the closing fees, can we say that all the taxing, the broker deals, the broker dealership fees. All your returns are based on net of these expenses. So if you invest $10,000, as Billy did mention there, you will receive your net 8% on the investment.
Yeah. So just to clarify, what we're saying is that it's not going to be a case where you invest $10,000 and then if you look on your wallet, it's only $9,800. That's not the case. It's a pure $10,000, all costs included up front.
So let's maybe just see if there's any other questions coming through here at the moment.
Someone had a question about the building. The spaces look deep for offices and there is huge amount of parking. Did this used to be a shopping center? It's a good question. Because of the history of the building, it's been it has its changes, but what we have to need to keep in mind is that this is the USA. Everything is bigger there. It's Texas as well, but yes, it was a general office store previously, which had some retail spaces to it, and was recent. I think it was around 2007. It was converted into the medical facility that we are seeing now. I don't know, JP, if there's any more questions. We are getting to the end of our time slot.
I think, yeah, it's nudging close to 60 minutes, and it seems that we've answered a lot of the questions. Ken, he's just excited that he got his, he won his award. Neville said, great, thank you guys for an awesome presentation. Look forward to seeing you online. It doesn't look like there's any other questions going forward. And with that, I would just like to thank you everybody for attending today. And we look forward to seeing you online and until the next vidcast. Thank you, Billy, for your time as well.
Yeah, no, thank you. It's been great. I hope to see you soon in another session. Have a great day and great evening, and happy investing.
Thank you, everybody.